Hello and welcome to this special edition of Commodity Champions. I am Manisha Gupta. Rising oil prices and robust global growth has helped drive the amount of money invested in commodities to the highest in more than 4 years. This is according to a report from Citigroup. The assets under management within commodities reached $445 million in the month of November, which is up by almost a quarter from a year ago, as retail and institutional investors poured funds in. This year's growth in retail and institutional assets in commodities follows large flows in 2016 as well. This is when the asset class saw the first net inflow since 2012. Some forecast that the strong economic growth over the next 2 years will sustain further appetite for commodities. An upward trend in the oil prices, of course, has been the key. The Brent crude oil prices, the international oil benchmark, has risen 16% since the month of Jan and is trading well above $60 per barrel for the last 1 month now, which is a 2-year highest for the crude prices. And this is thanks to a steady demand and supply curbs implemented by the OPEC and non-OPEC countries. The oil's backwardation, in which crude for immediate delivery is trading higher than the forward prices, has made it attractive for investors to hold long or bullish positions. The strong Chinese demand has helped the industrial metals in the meanwhile, which have outperformed all the other commodities for most of 2017. Beijing's decision to prioritize cutting pollution has placed restrictions on mines and smelters for many metals and minerals, including steel and coal, etc. Meanwhile, it also has to do with high expectations of demand for electric vehicles, and metals used for batteries has lifted the prices of copper, nickel and cobalt in this year. If you look at the copper prices, those are up almost 20% since the start of this year. And this year's rally in many commodities has left many cautious as well, as they warn that the prices from here will perhaps not see such huge growth and that the demand will cool down in 2018, as the buzz is that China's credit stimuluses and subsidies and new mine supplies will come online soon. Well, that is about the crude prices and metals, but the sector that is not closing this year well is clearly the precious metal prices. If you look at the gold, silver, platinum, all of that actually has given up much of the gains from where we started this year. But to discuss what is the outlook for commodities and metals for the coming year 2018, we are joined by a very special guest, Edward Morse, who's Global Head of Commodities at Citigroup. He joins us now. Edward, hi. It's always such a pleasure to have you on the show and talking to us. First of all, what is your sense? How would you look at 2017 and the kind of gain that we have seen for many of the commodity prices? And what would you really give all that credit to?
Yeah, there is profit taking. The commodities had a very good year, both in the first half and the second half. The overwhelming number of commodities had much higher prices than they did at the beginning of the year or the beginning of the second half. And that goes along with the much more robust global GDP growth, particularly in emerging markets, than anyone had forecast at the beginning of the year.
Well, absolutely. But Ed, even as the commodity prices really have been on the higher side, and we will talk about that in a bit, but the cryptocurrency really is the other animal with nearly 1,800% of gains. What is your take on it? Do you have a view, or do you think that, as everybody else has been saying, is perhaps a bubble?
You know, other than saying it has a lot of bubble-like characteristics, I'm just going to stay neutral on the subject. It's not within my expertise. I don't understand how this cryptocurrency can all of a sudden start trading as a commodity when it shares none of the ultimate characteristics of commodity land.
Okay, then let's start with the crude oil prices, Ed, and we have seen the prices gain up 40% from the June lows. Would you give the credit finally to the OPEC production cuts, and are these prices sustainable? That's a more important question.
Sure. So clearly the effort of the producers, OPEC plus Russia and a few other countries, finally started to work. They had a rocky first half of the year caused by their own internal problems, basically. They ended 2016 surging oil production by 1,600,000 barrels a day, all of that came into the market in the first quarter, so the production cuts as of January 1 didn't really bite. And then in the second quarter, there was this extraordinary rebound of oil production from Libya and from Nigeria oil that had been off the market. But finally, in the second half of the year, the production cuts started to bite. The market really is rebalancing remarkably rapidly. And we think this is going to carry into next year, but not be sustainable beyond maybe the first quarter or the first half of the year. We think that the high prices that we've seen is giving rise to much higher growth from unconventional oil in the U.S., and there's still a wave of investment that had reached final investment decision, some of it in Brazil, some of it in Canada, such that the supply side is likely to overwhelm these production cuts by the time the year reaches the third and certainly the fourth quarter of 2018.
Mm-hmm. Ed, I remember the last time when we spoke, you also talked about on how a lot of commodity or crude oil is getting hedged, especially by the first-time producers as well. Would you see that as an important cue also? And also, how would or what would you want to watch in 2018 in sense of fundamentals? And of course, would really want you to give us a crude price view also.
Sure. So we think average prices in 2018 are likely to be the same as in 2017. That is Brent at around $55 a barrel. We think of the year as being more like a mirror image of 2017, with price weakness coming in the fourth quarter, and then we look to a very bearish 2019, assuming that these production cuts come off, and if they don't come off, the price will be a little bit higher, and there'll still be more production coming from the U.S., from Canada, and Brazil. So basically, it's neutral year on year with a bearish tone to it, bearish 2019. But what could be different about it? First of all, there are 5 really fragile countries in the OPEC complex. One is in Latin America. The other are in West Africa, Nigeria, in Libya, North Africa, and then, of course, Iran and Iraq. And we think that all 5 of these countries are capable of seeing continued supply disruption of one sort or another. Certainly, Venezuelan production has factually been down for the last 2 years and looks to be sliding by another 300,000 barrels a day at a minimum going through 2018. Nigeria and Libya are at peaks. We don't think they could go up in production, but given the fragility of both of those societies, we think production could come off, and we think Iranian production is likely to slip for lack of capital spending, and Iraq could go either way. But all in all, these are bullish risks in the marketplace that we can't predict in any significant way. On the more bearish side, there's a potential at some point for slippage in global growth. Our economists are thinking of global growth being in the mid 3% range. That's up basically 0.5% fully over where we were at the beginning of 2017, the end of 2016. And if that slips, that's also bearish to the marketplace. But basically the question is, how does all of this oil taken off the market by OPEC countries and Russia, how does it get back? And can this agreement really sustain itself among the producers beyond the end of 2018, the point to which they've currently extended it? And there are doubts there, because the internal dynamics in Russia are very different from the internal dynamics in most of the Middle East countries. If Saudi Arabia has a $70 or $75 fiscal break-even price, the Russian budget is for $41. Everything above that is a surplus. The finance ministry and the central bank are very concerned about a rise in the ruble. Ruble is tied to oil prices, so they would like to see more production coming in the market for a weaker oil price, where they ironically gain from. And of course, all of the Russian companies are really eager to get production growth back in place. There's a record amount of drilling taking place in Russia. New discoveries are abounding. There are about 24 greenfield projects awaiting development that, in our judgment, could add 1 million barrels a day to Russian production by 2020, and even at a lower oil price. With a lower ruble relationship to the U.S. dollar, the government coffers grow. So that's kind of the tensions overall as we see it in the market going forward in 2018.
All right, all those numbers really don't give a very bullish view on the crude oil prices, especially beyond 2019, as you put it. But you touched upon the global growth estimates and perhaps a fear of slowing down onto that one. While, of course, we are looking at all of those consumers. But would you say when it comes to commodities, while, of course, there are a lot of factors and we just discussed that, it really is about the Chinese policies and the data that does play an important role?
Yeah, so at the moment, everything is resulting from whatever happens in China. And there are, mixed signals from China. On the one hand, fixed asset investment and property sales are plummeting. This is not healthy for commodities when you look at it in terms of the supply side. And undoubtedly, mining fixed asset investment has plunged the most dramatic of all of the metals investment areas of China. This, ironically, has a somewhat bullish tone in the Chinese market, getting rid of redundancies, restraining production growth. This gives rise to higher prices as we have demand settling in. But what happens with demand? We have a winter now where there are very stringent environmental controls, very stringent safety regulations going into effect, particularly in the aftermath of the 19th Party Congress. Everything is in the hands of Mr. Xi at the moment. And Chinese policy, when they're concentrated in the hands of a government, can be quite erratic with very difficult to predict results. Look at what happened just a year and a half ago when the government intervened in the coal market, a coal market which from a global balance perspective should be relatively weak. And yet overnight, with a curtailment of mining in the country, thermal coal prices went up 100%, coking coal prices went up 300%. It's a very difficult space to deal with right now when we have a government that is trying for lower growth, lower fixed asset investment, and where the demand for China-based commodities is really going down to the lowest levels that we've seen on a growth basis in a 20 to 30 year period of time. So I'd say that while oil is a wild card, as we've noted, prices could go up because of the potential for disruption risk. Everything China related is a wild card right now. And it remains to be seen what happens after the winter environmental regs are lifted after Chinese New Year, and whether we're going to see growth slowing down or growth being propped up.
Oh, well, yes. And I'm assuming that would be by the month of February, because after the winters are done and the Chinese New Year is done as well. But, moving away from China, and while, of course, that would continue to make an impact, Ed, what is your sense on the metal space? Are you picking up any favorites here? Because what a surge is what we have seen in some of those electrical vehicle components, like perhaps a cobalt or a lithium, where we have seen a triple-digit increase percentage-wise.
Sure. Well, our favorite in the short run is zinc and iron ore, and they're both China related. We think this is zinc's last hurrah. Zinc is going to be reaching prices that are likely by the end of 2018 to trigger new supply from elsewhere in the world. So it's really a story of now versus later, but now looks pretty good. Same for iron ore, where Chinese mines are being shuttered, where there's limited fixed asset investment, where there's a preference in the market for high quality iron ore, and where the robust discoveries brought into the market in Brazil and in Australia are kind of reaching not quite the end of the ride, but where we're moving to a higher level of what will be sustainable, particularly for rich quality ore. So those are the two extremes. In the metal space generally, we're looking for tighter markets ahead. We're looking for higher incentive prices, but we think those will come into the play year on year. For most of the metals, we see higher prices in 2018 than in 2017, but new supply by 2019, coupled with lower Chinese commodity-intensive GDP growth, should put a lid on prices and maybe bring softness to them by then. Our favorite play in the metals is actually, other than zinc and iron ore in the short run, is palladium and platinum, where palladium is in short supply, platinum is long, and where the spread between the two has been a rewarding way to invest, and we think that will continue to be a rewarding way to invest through 2018.
Absolutely. While we're closing this year in platinum, it is down in negative, but palladium definitely up by nearly 40% in 2017. Ed, what would you say about the gold prices? 5-month lows right now. We seem to have given a lot of gains here, but are these levels good to buy?
So the sector has been based on the rise and fall of geopolitical risk. It's been paying to buy the dips on gold because political risk is rising in the world. It's not going away. It's rising in advanced economies. It's rising globally, whether in the, because of unpredictable events in the Middle East or in Northeast Asia. So we think gold can't go much lower than it currently is, and we like buying dips in gold, and we like to see the high probability of geopolitical risk playing through in the market. We think gold is not going to be sustainable above $1,370 or $1,400 an ounce, but certainly at these levels, the path ahead looks up rather than down. It's a great hedge as well for the equity markets, which we think are likely to end their frothiness over the past year. So all in all, we're not, wildly in favor of long-term gold as an investment, but we certainly are in favor of gold as a basic geopolitical hedge.
Well, that point is well taken. Ed, what's also your sense on the US dollar index going forward in 2018? It has been a talking point in this year. While most of the year we saw weakness in dollar, it is holding around 2-month highs right now. What is your sense on that on 2018?
Well, our economist forecast for the U.S. dollar is lower a bit. We don't know what's going to happen with central bank rate increases. It depends on whether there are 3 or 4. But even with 3 rate increases, we think the dollar is on a weaker path ahead. This should be, generally speaking, of comfort for commodities, because we've kind of gotten used to, or the investor community has gotten used to a strong negative correlation between the U.S. dollar and commodities generally, given the denominator effect. But we think that play is basically over as commodities are going their own way and as fundamentals seem to be much more important than the dollar play at the moment.
All right, Ed, we'll let you go at that. It's always a pleasure talking to you. That is the view coming in from Citigroup. Then they are expecting the US dollar to continue to weaken, and that, of course, would be supportive for commodities. As he said, 2018 seems better than 2017, but not so good is the view going forward for 2019. With that, it's time for a quick break. When we return, we will also be joined by Kishore Narne, Head of Commodities at Motilal Oswal, who would also tell us about 2018 outlook, top picks for him.